We are live now.
Okay, so good evening, afternoon, and morning to everyone who's joined our discussion. We're talking about investing in 2021, head for the hills or head for the hype. This is how we decided to couch this discussion. Now, by way of brief introduction from me before I get on to our speakers, I think it's fair to say that most of the world has kind of gone crazy in the last year, and they sort of feels like it's sort of continuing to go crazy. But at the same time, the question is, have the financial markets gone crazy? Or is there a bit of a method to the madness that we're seeing in the markets at the moment? This is a question I have. And as we look ahead to the rest of 2021, what are the opportunities and how do we avoid falling off a cliff? And so to unpack these questions, we have two phenomenal speakers with us. First, we have Dan Wolfe, who's the managing director of Simoleon Long-Term Value, a fund that's been investing extremely successfully in crypto assets. And Dan's also, by the way, an independent director at Sigeja and Uralkali. So hi, Dan.
Hi.
Next, we have Simon Fentham-Fletcher, who's a co-founder and chief investment officer at Freedom Asset Management. And I hope, Simon, you won't blush too much if I point out to our audience that you're ranking top decile globally by Bloomberg in all investment timeframes. So, gentlemen, thank you, welcome, and let's get started. So the first question I'm going to put to Dan, if you don't mind. So Dan, at least I think to the untrained eye, right? There's been something kind of irrational about equity markets over the last year and so on. You have the world in chaos, as I mentioned in my intro, and at the same time, so many stocks have just kept going up and up throughout this whole time. Today we had this great sort of story that was breaking. It's been breaking over the last few days around GameStop, which has sort of been up 1,700%. And in the New York Times today, they referred to this as dumb money and a case of small-time investors beating Wall Street at its own game. What do you think is really going on there? And could this maybe mark some kind of shift from the sort of shift of power from the insiders to this sort of new, well, retail investors, or maybe even internet-fueled mobs, if you will? What do you think?
Thanks, Tom, and really appreciate your moderating. Well, I mean, I think I don't like to think of any money as being dumb or smart, right? And I think in a way, if you think you're smarter than the market, that usually is a great way to find yourself in great pain. But I don't think this is the wisdom of crowds either. I think we have a bunch of things happening. One of the things that's happened is there's been this explosion of retail investors. In the United States, I think it's something like 21 million new investors in the last 18 months have become investors. And, it's not just an American phenomenon. In Moscow, the Moscow Exchange in the month of September added 50,000 investors every day. So we have this explosion of retail investors, and I do think that they tend to be much more driven not by the fundamentals that people like Simon and our team look at, but really by momentum and stocks that they know and so forth. And we've seen that not only with GameStop and some of the other things like BlackBerry that have exploded, 245%, and bankrupt companies. Hertz got a big pop last spring when it filed for bankruptcy, which is quite shocking. And I think, part of this, I do think, is part of this anti-establishment and lack of trust in authority that we see, in American politics and in other countries as well. This sort of eat the rich. There's a lot of celebration going on in the chat rooms about how they've forced these hedge fund managers to go bankrupt, and so I think that there's part of this, but I also think it's foolish to discount the risk. A lot of this is driven not by the buying of stocks, but by buying options, which I know to be an incredibly dangerous and risky proposition, particularly for people who are doing it with their last money, their rent money.
Yeah, and I think if you think about this, right, I mean, with this sort of drive of retail investors and more, let's say, emotional investment decisions, and you combine that with this whole environment that we all live in of, let's call it the fake news environment, or this sort of willingness to make decisions based on belief rather than facts. You combine all of this is a pretty dangerous situation in a way, and potentially a lot of people are left in tears here. And I want to put the question to you, Simon, given all of that, and the sort of the clear risks that are developing here that, you know, will hit at sort of the ordinary people who don't necessarily have the qualifications to be making some of these decisions. Does that call for a need for a new kind of regulation, tougher regulation or different regulation, or do you think that it's ultimately still for the market to work this out?
Tom, thanks for having me here. Always good to sit down. I think before I answer that, I think it's important to say the rise of the retail investor over the past year, the phenomenal numbers that have been put on across different platforms, we've got to remember where it's come from. We've all been sat at home. The vast majority of people have been working from home, unable to get out because of COVID. So the rise has become because people have had too much time. I have innumerable friends that don't trade that are now trading. So I think that's one thing that I think that this acceptance of trading will start to go away. A number of those people have already said, look, it was fine while I was sat at home, but the amount of time I was spending to get it done means that now I'm actually going to start looking for a profession. So, and then you get back to your question, which was, are people going to get hurt? Always is the answer. And it's the people. The thing about investing is the vast majority of people are driven by greed, and greed is a dreadful motivator. You should always invest. You shouldn't be just trying to double and triple your money. That's just it's not sustainable. Greed is a bad thing because if you look at GameStop, the vast majority of these gains, they may have, it was started because they were going against the short sellers and they were making significant amounts of money. I wonder how many of the people that started this movement are still in the stock now, or whether they sold out and cashed out their gains and are running off. And the people that have kept driving it up are the people that have seen this thing happening and they've just been driven by 20, 30, 40% gains in hours. Or, and so it's generally the moms and pops right at the end. They're the people that always get burned. And so in answer to your question, yes, they will. And it won't be the people that did it maybe for a moral reason, but they've probably cashed out. Do we need extra regulation? That's a difficult one because I don't think we don't stop people going to the casino. In the vast majority of the planet. We don't stop people buying stupid fast cars. We don't stop people doing stupid things. Stopping people buying expensive stocks is, it seems, are we the nanny or are we not? So I think the idea that you need more regulation to stop people losing money is wrong because that's what a market is. Do we need more regulation if it's been driven by internet mobs where it's collusion? And if it's collusion, that's wrong. And with GameStop, it's in many ways it's a bit like the old, the sort of the penny stocks of the US. So it's a pump and dump scheme, and that is definitely. I mean, if the notice boards are causing that, then that's wrong. But regulation to stop people losing money. I mean, sorry, we don't need that.
Absolutely, but as you're saying though, it's that if this is happening, then it's wrong. I guess it seems like it is happening. So that there's still a question for whether it's regulator or market or whatever it is. There's still an issue that needs to be solved. Dan, I think you were about to jump in.
Yeah, I today there was other news that Robinhood actually suspended purchases of GameStop and a whole bunch of these other stocks. And I think this is actually going to play into this idea that Wall Street is for the hedge funds and the other wealthy investors and the banks. And so I think it's important to address this idea of trying to make sure that the markets are fair and transparent. And partly, we'll talk about it later, I hope, decentralized finance and some of the things that are happening in the fintech and blockchain world will help to do this, to provide good access. But this is an old story. This is stuff that we saw in the 90s for sure, and certainly, in my opinion, a lot of what's happening with the high frequency traders is also giving guaranteed profits to Wall Street guys. But the Robinhood thing is quite interesting, right? Because the name is about stealing from the rich, and what they've done is, in the exact moment when they're putting enormous pressure on hedge funds and other big Wall Street players, they're being dealt out of the game.
Yeah, no.
sorry, Tom. I think it's really interesting the blocking of certain stocks on different platforms. One of the things that I'm sure they've been in contact with the various regulatory authorities, so the SEC, because if there's any way that that they're stopped just purely because they don't want to take that stock off, I'm sure they'd be opening themselves up to all sorts of lawsuits. So I think that before they did that, I'm sure they must have been in contact with the regulatory bodies of the various exchanges, because there must have been something going on that they deem to be slightly suspicious or illegal, and that's why they've been taken off. If they've been taken off purely because of this going on, then let's hope the platforms collapse.
Yeah, no,
And
absolutely. But I would just point out, this story is still playing out. So there's still more for us to find out about what's actually been happening behind the scenes here. And so the coming days are going to be interesting. Yes, Dan.
And just one other takeaway. I just want to say that, like, just to emphasize for those of us who are investing, and this is something that certainly in the crypto world is very important. These are not investors that are driven by fundamentals. These are not people that can tell you how the PE of GameStop is changing or how their net profit is falling and so on. This is sentiment-driven trading, but so is Tesla, right? Tesla's worth 7 times GM and Ford put together, and I think any investor now needs to understand that this kind of sentiment investment can drive markets to places that maybe we might think don't match up with the fundamentals, but maybe the fundamentals will change if the markets will be more driven by sentiment in the future.
Before we move on to our next topic, I actually just want to take a question that's come through in the chats around collusion, actually. So I'll read it out to you in case you don't see it. So on the idea of collusion, it seems to me that hedge funds exchange stock ideas and use their leveraged balance sheets to support stocks that they as a group like, don't they? So it's a question from Dapan Biswas, who's put that. Simon, do you want to give a quick comment on that?
I think collusion in-house, possibly. They're talking between desks, but not collusion between different funds. Then they get into trouble. But yeah, I mean, stock manipulation is fundamentally wrong. We're supposed to be in a free market. Anywhere that it's done, whether it's in a hedge fund, and there are innumerable cases of hedge funds or other market participants committing insider trading and various other things. But if it's done on a message board, it's equally wrong. We just need to understand there's right and there's wrong, and so.
Yeah, and I would just say, Darpan, thanks for the question. Also remember that this Melvin Capital, which is the guys they were originally shooting at when they started buying GameStop, they got a $2.5 billion bailout by Steve Cohen and another hedge fund. And we all know the reason they did that, right? I mean, what happens when your bad bets go wrong, you start selling your stocks. And there's, the thought is these guys were afraid that if they started selling massive amounts of the positions that they have, there might be some overlap in the positions. So they were defending themselves. So it's certainly true, I would say, that Darpan is right, that what we're seeing by the masses is something that happens at the very top of the food chain as well.
Darpan, thanks very much for the question. And I'll just remind everyone, so feel free to put any questions or comments in the chat or the Q&A box. We'll be happy to hear from you and take your questions if we can. Maybe I can suggest we move our discussion along here. Simon, I'd like to come back to you here. And let's talk a little bit about the traditional equity markets. So if you look at where sort of valuations are today, so forward Ps for the S&P 500, for example, at around 23, when they've historically been around 17. So there's a big sort of bump in the valuations here. Should we expect a correction in 2021, or do you think this could be sustainable?
I mean, what's driven the rise from historic levels to 23, I think, is important. So in the past few months, I'd say that vaccination hope is probably one of the big reasons for asset price growth, and then the hope of fiscal. So the hope that Biden gets $1.9 trillion relief bill through, and then all of a sudden you get another $2 trillion infrastructure bill. Those are the things that I would say have been principally driving asset growth over the past few months. I would also say, and this is really interesting, because Chairman of the Fed yesterday turned around and said there's no correlation between low interest rates and increased asset prices. Now, I'm a bit skeptical about that. When we have interest rates at zero, which then if we factor in inflation, let's be honest, with Air borrowing at 1%, or Cathay Pacific at 5 to 10-year notes of under 3. This is insane. So we have the fixed income world that is broken post GFC of 2008 and the stimulus there, which means that we now have an environment with benign rates. So the US 10-year is paying 0. Sorry, the 5-year is paying 0.4. The dividend yield on the Nasdaq is double that. If you look at the S&P, it's like, we're talking nearly 10 times that. It's 8, but it's it's round to 10. So we have a fixed income market that's totally broken, where the vast majority of bonds are owned by central banks, and then you have equities. So if you need income, where'd you go? You go to equities, and so that's one of the. I mean, we can see that the rise of equities has been driven by dividend payers. So divvy payers have gone ballistic, which means their prices get bid up. All of a sudden, you get PE ratios that are not realistic. I will also say, last year was COVID year, and as a result, earnings were brutalized artificially. So we are going to see some increase in PEs, because the earnings will come back. To what level we don't know, but they will come back. And earnings numbers that are coming out now are very, very good. So do I think they'll come down in 2021? No, is the honest answer. I think that there are risks. I believe there is substantial upside in the equity market, because the fixed income market is broken, and that I genuinely believe that the wall of money that we had last year is still causing ripples all the way through. So this mountain of liquidity is still trying to find a home. It wants to get paid, and if it wants to get paid in anything that's real, in real terms, then it needs to move into equities and divvy payers and all these other things, and to get not just potential capital gain, but also. But there are significant risks, as we saw yesterday. Volatility, and the best way of ruining a reputation is to make a prediction. I always make predictions at the beginning of the year. I said this year will be double digits, but it will have insane bouts of volatility.
Well, I'm going to caution you that during the course of this discussion, I'm going to be insisting on some predictions, but don't worry. If the reputation gets trashed, I'll help you recover it. I want to give Dan a chance to comment on this statement. Just before he does, I'll flag another question that's come through from Michael Danov, which is, how do you guys see hedge funds changing their strategy going forward and protecting investors' interest? So Simon, you might want to think about that, but Dan, a chance to comment, and then we'll come to Michael's question.
Yeah, no, I mean, I agree with Simon. It's hard to ignore this massive liquidity that's come from central banks all over the world, and negative effective interest rates, they do cause people to look. And I think in part that's what's driving some of the new money that's gone into Bitcoin of late as well. I think it's also important to realize that the markets have changed quite a lot in the last 15 years. The US market is now more than 25% ETFs. And so we have a tendency when people go into the markets to see the whole market go up because you buy ETF, and you see some stocks really getting ratcheted up because they're in the index. If you have an active manager, they might stop and say, you know what, I have enough Apple. But if they're just an ETF, they're going to say, well, I need to buy 6% Apple because the market went up 1% and 6% of that is Apple, so I'm going to buy that. So I think it is a changing market, and it might mean that the numbers are changed. The other question I think that we need to think about is, if history is our guide, all of this liquidity, much of which has been from money printing, is likely to cause devaluations across many of these currencies. And so we may see in the future a need for people to be careful not only about generating absolute returns, but understanding what is the currency risk of the currency that they're holding. Just for example, the Federal Reserve, it's on its own site, indicates that 35% of the US dollars in all of the world were printed last year. If that were the ruble, it would be 600, right?
Yeah, and within you mentioned Bitcoin, and we will come back to that. But just before we do, Simon, do you have a view on this question around how hedge funds are thinking and how they may be changing their strategy going forward?
Protect investors. There are many people that say they do very little to try and protect their investors. It's fascinating. The hedge fund world, and I've spent many years. I've invested in some of the very best hedge funds. I've met the vast majority of brilliant hedge fund managers on the planet. The vast majority of hedge fund managers, it's almost a game for them. It's an intellectual game that they're trying to win, not necessarily to make money. And so investors are a mechanism for which they almost prove their intelligence. So there are other hedge fund managers. So it's almost a competition between each other. I don't see them necessarily changing the way that they were. I don't believe it's a rigged game, like some of the discussion boards are saying, especially since they're very much in competition with one another. So I don't think investors need to be protected any more than they are already. And when they sign up to it, if you've ever seen a hedge fund subscription document, you'll see the risk disclosure page is like that thick. It's like enormous. So technically, you have to be a very professional investor to invest in a hedge fund. You've signed up to 1,000-to-1 different clauses on risk associated with your investment. So if hedge funds become more retail, that would be a significant problem for me. Hedge funds they're specialized and they're for special people.
Yeah, and I would just add, Tom, that I think the concern is really for something more like 2008, where you have hedge funds wiped out and there's a follow-on effect that wipes out large parts of the economy, that makes it hard for businesses to be funded, that causes fiscal pain for governments because they have less tax revenue. And so I think that's really the concern. And if you think about it, like in the United States, the numbers I've seen, 45% of the people don't have any investable assets. So they have no upside. The last few years of incredible market performance have done nothing for them. But if the hedge funds collapse and cause a cascade that causes real economic pain, there will be a lot of suffering. And I think that will cause, at least an attempt to do some more regulation of the markets.
Tom, just to come back very quick. I think it's a really, really interesting question. Where does the next financial crisis come from? And even in the fixed income world, we now have some of the gods of the fixed income world saying, there's almost a time now to have debt forgiveness of the G7. Now, to go back to Dan's point about currencies, this is fascinating to talk about debt write-offs of U.S. Treasuries, or different sterling assets or various things. That can cause some significant problems. I think Dan's very right in the fact that hedge funds falling over could have knock-on consequences for retail investors. But I think the fixed income world poses much more of a danger to the overall financial system than necessarily GameStop going up stupid amounts.
And both of you have a number of times mentioned sort of retail investors and the growth of retail investors sort of throughout. And I think that, again, as we're thinking about risk and protection, this is clearly an evolving issue that countries around the world really need to be thinking about and grappling with. Dan, let me come back to you. As I mentioned in the intro, we know your fund has been very active investing in different cryptocurrencies and digital assets. Bitcoin was up 300%, I guess, in the last year. A lot of people are obviously saying it's a bubble. There are plenty of skeptics out there, but how do you see that? We're going to see a decline in the short term? Is that inevitable, or might this sort of rise just continue on?
Sure. Well, remember, we're almost 25% off the highs, right? We're close to 30,000 today when we were up over 40,000. We look at Bitcoin as digital gold. It's a store of value. So, its main purpose when it was created is for people who are anticipating that all fiat currencies, which is what we call currencies issued by governments, will eventually decline in value because they're going to want to print money either for the next election campaign or for a war, or because they have too much debt, whatever it is. So, we see this as a trade that's going to go for a long time. And yet, to Simon's point, I think we should expect a lot of volatility as well. Interestingly enough, if you look at Bitcoin over the last 12 years, on any year-to-year basis, if you pick October 14th or December 1st or whatever, it's only been 1 year it's been down. So it's volatility that's going up. And one of the reasons is because it's fixed supply. There's only 21, there'll only ever be 21 million Bitcoin. But I think also one of the things that's happening is something we've been expecting to happen for the last few years is institutions are starting to enter into the market. And so we're going from a market where, you know, your average trade was around $5,000 to now where you have more than 20% of the market with $100,000 trades or more. And so as they go in, you've seen MicroStrategy, which is a NASDAQ listed company, which is now basically a Bitcoin play, I think. Square, which is a big financial services company. They've not only gone into Bitcoin, they're actually teaching other corporate treasuries how to find a roadmap to that. Paul Tudor Jones, Guggenheim. And as that institutional money comes in, it will raise the price because you have a limited supply. And so I think that's what, and I think right now we're in the place where, you know, no institution wants to be first, but no institution wants to be last. And so I think we're going to see a steady increase in the overall capitalization of Bitcoin as more and more corporate treasurers decide to add it to their reserve currencies. And one of the things that's most important for this is infrastructure. So Fidelity now provides custody as well as buying and selling for its corporate partners. So corporations now can buy Bitcoin with a partner they've been working with for many, many years, and that infrastructure is growing. Goldman Sachs' Circle announced today that they're creating APIs which allow people to on-ramp you from dollars into, they have a stable coin called USDC. Again, this is a Goldman Sachs investment. And they're going to provide this sort of interoperability between fiat currencies and crypto. And so as this infrastructure comes on, it makes it easier for institutions. Institutions want to. So I see us entering a situation where we go very positive. And one last thing to think about, which is really interesting, is Gary Gensler, who's been nominated by President Biden to be the head of the SEC. In addition to his many years at Goldman Sachs and his time in the Obama administration, after that he was teaching for the last 4 years at MIT, and he was teaching courses on blockchain. So this is somebody who's known as a really good regulator, but somebody who deeply understands the technology and its transformative nature. And so I think we'll see, you know, sort of intelligent regulation, which is a super positive thing for the market.
Yeah, I think having regulators that understand the subject that they're regulating might make for a refreshing change. So welcome aboard, sir. We have a couple of follow-up questions around this topic, but before we do, Simon, let me come to you for a bit of a response and reaction to what Dan's been talking about here around Bitcoin.
I mean, Bitcoin, we were talking about faith investments earlier on. There was an article in the New York Times recently where talking about Bitcoin being faith investment, and you know, and you were a believer almost in religious terms. And Bitcoin has its own holidays. The date of the first pizza transaction is a Bitcoin holiday, and it's fascinating because you have to have belief. You know, you have to, but you've got to. First of all, you've got to love what you do, but you've got to believe in what you do. So I don't have a problem with Bitcoin at all as an investment, as the whole crypto space as an investment idea. That for guys like me at the moment, and Dan's touched on this, it's the size of the market. So when the size of the market is about the whole crypto space being about the size of Tesla, one company, or Apple, one company, then you know, the amount of time that you have to devote to this is significant to understand it. It's like only investing Apple in a multi-asset portfolio you would never do. So there are now. I fully understand. BlackRock just allowed some of their hedge fund managers to start investing in Bitcoin. The demand will come. I'm not sure because of the limited supply, and we'll talk about, I think we're going to talk about DeFi and ICOs later on, but because of the limited supply of things, you have there's a bit of an issue. I love the idea of crypto in the fact that we have the potential for other stock markets to give birth to like new places that we can go and invest. As an investor, it's fascinating because you want to have I'm always looking for new ideas and themes that will become larger plays later on. It's still too small for my portfolios. That's not, I loved the idea 4 years ago, and I looked to get a Bitcoin fund off the ground. At that point, there were custody issues. Now a lot of it's changed, but I mean, you know, it's often better when this guy over here we're in disagreement with each other. But sometimes good ideas are good ideas, right? And you know, Dan said some really sensible things there. I just think that the market needs to expand a bit, and the institutionalization of that will make it better. Will that make it less accessible, or will it drive the internet hordes away into some other place? There are many questions, but I love the evolution.
So part of what we're talking about here is it touches on supply, and actually that's one of the questions that's come through in the chat is around supply and sort of the notion of limited supply. And the specific question, which I'll put to you, Dan, is why can't the miners agree to increase the supply of Bitcoin once they stop earning the block subsidy? So like buy the Bitcoin mined in each block. What do you think about that? Is that something that might be
that must be another DARPon question?
It is indeed.
It's a really good question. And there have been changes to the Bitcoin code over time. My personal feeling is that they would be shooting themselves at best in the leg, and probably higher, if there was ever to be a change in the supply of Bitcoin. You know, every Bitcoin is broken into teeny tiny Satoshis, and I think we'll just become more comfortable with what in the regular are called sats. So I personally think it would be such an attack on the fundamental premise that it would be suicidal, and I find it hard to believe that investors would want to do that. But on the other hand, I also think, and Simon sort of mentioned this in a way, I also think that we're very quickly coming to a place where if Bitcoin dies, that's okay, because we're really talking about an emerging asset class. We end up talking mostly about Bitcoin and a little bit about Ethereum, but there's a universe of other things that are coming out that, you know, I think over time will be probably more interesting than these assets. So, so my feeling is there'll be limited supply for quite a long time, but even if they decide to do something incredibly stupid, that it won't remove the fundamental argument for why there should be decentralized assets, including cryptocurrencies.
Another question that's come through, which I'd like to put to both of you, so Simon first, from Pierre Heistein, which is, what are the possible events or factors that could delay or even cancel entirely the entry of institutional money into Bitcoin and maybe other crypto assets? I mean, Simon, if you think about that, what could sort of take this off the table for the institutions?
I think the dam's already burst on that. I think it's going to be very hard for anything to take it off the table for institutions. It would something, as Dan hinted to, something being stupid being done with the code would probably be the one thing that would drive people away. The volatility is not something that people worry about necessarily. I think with crypto, we have to understand, Dan said it's a store of wealth. You know, is it a store of wealth? I mean, when it is this volatile, the vast majority of people that are playing it are not playing it for a store of wealth. They're playing it because they think it's the new GameStop, or they see the as Dan pointed out, the rapid rise up and the consistent rise up, and they say, I'll have a bit of that. So I think, we also have to understand what is it, and I think one of the great things about crypto is the blockchain. The blockchain is the great thing about crypto. That's the thing that's really usable. Crypto is just a consequence of it. But I think from my point of view, it would be code stupidity on code. And I'm with Dan. If Bitcoin died through stupidity, then crypto as a whole would take a massive dent.
Yeah.
And if you want to think about doomsday scenarios, there's two that I think would actually wipe out Bitcoin, particularly for institutions. One is a hack, right? So we're all functioning under the conviction, which has held for 12 years in a world where it would be very valuable for a hacker to successfully hack a private key. But if there were a hack, obviously all bets are off, right? People will head for the exits. So that's one thing. A second thing is there are a number of wallets that were created early on in the life of the Bitcoin blockchain that have not moved for many, many years. Sometimes they're called Satoshi wallets. I think if those started moving because they have millions of Bitcoins, they might also scare away the institutions because they'll feel that there's some underlying uncertainty that they can't understand. And then just to push back against Simon a little bit, one of the nice things about investing in blockchain assets is we have all of this data in the blockchain, and there are great people like Into the Block, which is a group of quant computer programs who are studying the blockchain. And so we know, for example, that the average Bitcoin hold is 3.1 years. The average person holding Bitcoin has had it for over 3 years. So I think to me that indicates that there is, sort of a pretty large group of people that are in the Bitcoin lingo hodling, holding for a long time.
I can also foresee a scenario where, let's say, UBS or someone like that builds up this huge kind of portfolio of crypto assets and then loses its password and isn't able to access it. That might make them kind of feel like they want to pull out as well. We've got some other very good questions coming through. We'll take one or two more around this topic, and then we'll move on. So one interesting question from Dimitri, who's listening, is you mentioned Dan, the head of the SEC, who understands blockchain, puts the question, is there not a risk that he'll actually see that this represents a threat to the US and the US dollar dominance in finance, and therefore might that make him actually less inclined to support its development?
Well, again, I think his interest in it is like most people are deeply interested in, is in the idea of creating decentralized financial institutions. He's not the head of Treasury, and he's not the head of the Federal Reserve System. But to be honest, I personally think it doesn't matter, right? In regulation, we always talk about a race to the bottom. And so Singapore is racing ahead with regulation. They have a sandbox. They have many already interesting regulated blockchain entities. The Chinese have a central bank digital currency that's already in use in 5 cities. And so I think, the US could decide to cut off its nose to spite its face and move outside of this enormous, innovative, interesting financial development. But I think they won't. But if they do, it's not going to matter.
Mm-hmm.
And you've also got many of the central banks turning around and looking at have a digital pound or a digital, and the Bank of England specifically looking at this. So I think that's quite fascinating. I don't think regulation is a bad thing at all. I think regulation it's a good thing to have this. To go back to our previous questions and comments, that's otherwise it's the moms and pops that get burned.
Yeah. So let's actually move on a little bit. We'll come away from crypto for now. And I'd like to pick up on some of the other, let's say, quite big, hot themes that have been driving a lot of discussion and excitement in the markets over the last couple of years and continue to. So one of the things we read about, Simon, now is the rise of SPACs. We have more and more of these coming up. I mean, amazing amounts of money that are being invested via this kind of vehicle. Last year, we had the big cannabis theme and continue to have that. You have sort of solar that's getting more and more people exercise. So not sure you can pick up on all of them, but what are some of the themes that I've mentioned or others that you're excited about that you think are going to be really are going to be able to sort of sustain interest going forward?
Okay, SPACs. There's now an ETF of SPACs, which that just shows you how mad everything is. If anybody's interested, you can go and buy an ETF of SPACs. SPACs are with zero interest rates. There's real issue with private equity. SPACs are the new VCs. So it's I think there's a real danger of just writing a check and just go and do whatever you want. I have a fundamental issue with that because I believe a manager should be judged on what he's done in the past and have investments that he wants to do. I don't think you just write a blank check to anybody. So a great danger, especially, when there's so much money trying to chase different things, you'll get prices bid up. Then people will overpay because they know that any debt that they put in there is interest free. And then we all know that inflation is around the corner. And then as soon as those interest rates go up, all the debt is hard to service and the zombie companies die. And that, again, you want to talk about protecting mom and pop and the trouble of financial industry. Rising interest rates and the end of zombification is one of the principal things. I have a major issue. I'm anti-SPAC, fundamentally. One of the interesting things I've been playing this theme since 2020. I've been playing solar. I've had a stock that I bought at 650, and now before yesterday it was up over 50. So that's not a bad return, nearly 1,000%. So I quite like that. It's not GameStop. It's got a fundamental business. It's growing. It's doing really well. Nobody's really trying to short it. But it's so yeah. Solar. I mean, the idea of clean energy is one that all of us with children would love to think is not just a great investment idea, but one that can change the way that the planet is. So ESG is a dirty word because there's so little sort of the idea of ESG is so dissimilar in different places, and so there's no consistency of application. But the idea of investing in things that specifically that are going to be beneficial to ESG ideas is a very good one. And it's an idea I've been playing successfully. And yesterday was a bad day, but a very bad day, a dreadful day, and we're not going to price that portfolio until tonight. But no, I think it's the idea that you can move around as crypto. I love new ideas and new themes coming through. Solar was an idea that I started playing. Clean energy generally is an idea I play. So it's a fascinating thing. SPACs, stay away.
We got I got an moderator endorsement for raising cannabis, and so I'll take that, and I'll come to you, Dan. Are you a fan from an investment standpoint?
Sure. I think any new market that you're going into is it's gonna be big, and I think I'm a big believer in alternatives to pharmaceuticals also, and I think there's a lot of benefit. When my mother had cancer, which eventually killed her, she was in California and was able to moderate the worst effects of chemo with cookies that she could buy at a pharmacy. And I think that's awesome. I think cannabis is a really interesting play right now, just because we're really, again, I like emerging asset class. It's emerging, right? It's not even nationally legal in the United States. And so I think, we have a number of very obvious events which will cause these to really increase in value. And I also think we'll see much more crossover between, the great brands in alcohol and in luxury goods beginning to buy out some of the bigger players in cannabis. So I think it's a smart thing to invest in. But, like any emerging asset class, my advice is always, find somebody who's, literally waist deep in that stuff every day, because it's really hard to understand. And anything that just emerges, it always, invites the charlatans and the promoters and worse.
Yeah,
I will add that it's probably only in the Western liberal democracies of that cannabis will become a major, obviously, marketplace.
Sure.
We've got a few more topics I'd like to touch on in the 15 minutes we have left. And Simon, I'll come to you around the sort of the changing asset management industry generally. And so I think that you hear more and more doubt about the need for active managers and how this is sort of driving changes for institutional investors, and also fintech, which is really also kind of coming in and very much disrupting the traditional landscape. And so in the context of some of these themes, how are you thinking about the sort of the future of the asset management industry?
It's really interesting. I mean, I'm a dinosaur. I've been in it for so long. When I started, I had such beautiful long blonde hair. But no, the asset management industry, the whole total finance industry has changed so much. One of the things that we obviously, with Big Bang and deregulation, we saw that is Tom. That you've got to introduce her. Everybody, that's Tom's daughter. So post Big Bang, we saw the rise of the Big Bang. One of the things that's happening, guys like me that were inside that great big machine have got bored and tired, and we started our own businesses, and so it's owner capital. So we're almost going back to the 1920s and 1930s. I don't know whether to address the owl or Tom, but it's an amazing thing that's happening. So I think the evolution of the market, in the same way we have the evolution of products, we are seeing an evolutionary of firms. The rise of the ETF went from, it was just a fee thing. So people said, I don't want to pay asset management fees. I just want to I want to pay a low fee. And they said, in big markets, there's no differentiation. You may as well just take the average. And I would always say, do you wake up in the morning and say, today I'm going to be average? Or do you wake up in the morning and say, today I'm going to be as good as I can be? And that's the difference between, or average less fees even. So I think there's asset management is aspirational. Now there ETF movement ETF industry has evolved. So you now have managed ETFs, and you have there's discretionary involved. And this is not necessarily a bad thing. People using ETFs broadly, I think they're not getting the most out of their potential gains. They're not to say that they will lose their handbag. So there are different risk appetites. ETFs are for a specific type of investor. Generally one that is burnt at the end of things, because they're not run, they have headline risk. So everybody that's invested in Apple, all of a sudden, there's a great scandal about Apple in the Far East and its production policies, and how, whatever is going on. Apple gets murdered in its share price, and every ETF gets murdered in its share price. But if you're an active manager and you've ridden Apple all the way up, I own Apple, but I'm not going to say that I'm out of it. Then you can choose which names you want, and you can avoid that headline risk. So
Thank you, Simon. And my daughter didn't agree with some of the points that you said, but she said she'll follow up with you via TikTok a little bit later.
Okay, TikTok.
Dan, one of the other big themes that's come up in a couple of questions from the audience, and I know you were going to talk about, was around decentralization and how this is maybe increasingly aimed at disrupting investment markets. And so how do you see this? What is it, and what is it really going to change?
Yeah, sure. Just to a few comments on what to add to what Simon said. I think there'll always be a place for active asset managers in emerging asset classes, in emerging markets where you do have challenges for execution and you have challenges for information and so on and so forth. And I also think there's always room at the top. So I agree with that. But I do think we're going to increasingly move to incentive structures that are more aligned with investors and lower overall fees for asset managers. I just think that's, baked into what we're seeing. The idea,
Dan, very quickly, it's always net returns and not necessarily the fees.
Sure, agree. But a lot of people pay attention to the headline fees anyway. And when I say that, what I talk about is I think about a $3 billion private equity fund, where if you're a partner at that fund, do you really need the performance fee? If you're getting 2% on those? No. So to me, that's a misalignment. But anyway, to go back to decentralization, I do think that it is actually designed in some ways to address exactly this problem. And the idea, they call it DeFi, decentralized finance. And the basic idea is that you would have a public, global, all-inclusive alternative to the financial offerings. And part of this is just going to be pushing out into a broader audience. There's at least 1.7 billion adults that don't have any banking relationship at all, that don't have credit cards. According to Credit Suisse, 90% of them have smartphones, right? There's $60 smartphones in Africa. Those people will never have a bank account. There will be a digital ledger that affords them with what they need for their financial transactions. And the reason that this is super interesting and how it'll happen is most of it is open source. So anybody can look at the code, which generally tends to make the code much, much less hackable. It should be widely available, and it should be modular. So the idea is that you create architectures that somebody in Kenya or Indonesia or the Deep South or in Scotland can build something and then provide financial services, maybe to their neighbor or maybe to somebody who's across the world. And so, we're going to end up with offerings that are more transparent than we generally have now. I mean, all of us, if we're invested in funds, every quarter you get this big book. I don't think anybody ever reads that book except the lawyers, and we'll have ease of use that's really going to be super powerful. And so examples of this already exist, right? We have stable coins, which are tokens that are connected to other assets that allow people to trade in and out of Bitcoin or other crypto assets or tokens without having to go through the very slow pipes to get to fiat. And we have decentralized exchanges where people trade not through a centralized exchange that has rules and hours of operation, but through a computer program. And I think we'll see a lot more of that. You know, in the last year, DeFi lending, which locks Bitcoin or Ethereum usually into a smart contract and lends against that. You know, it was a year ago, it was 840 million in total locked value. And now the total value locked is 25 billion. So it's, you know, growing very fast. You know, again, I don't think we replace the banking system, but I think we'll see increasing amounts of interesting offerings there. And decentralized platforms very often, you know, are not designed to make any one group of shareholders or managers wealthy. And so as a result, they tend to be lower cost for the participants.
Yeah.
I have a question, very quickly. How many DeFi crypto offerings have failed? Like
I mean, like the crypto market is just littered. You know, I would say so it's if it's not 99% of the crypto offerings, it's pretty close. And part of that is the absence of regulation, and it's an unsophisticated market. So, you know, and again, for us, you know, we see that as an opportunity because, you know, in an asset management world where people are at least not entirely convinced that they should pay people for active management, we see this as, you know, this is why we're here. Is to actually study that, because you have to be really careful. And so we do stuff that, you know, may seem counterintuitive in the decentralized world. Like if we're interested in investing something in Polkadot, for example, which is an interesting infrastructure play, we call the people who are the founders of it. We say, hey, can we jump on a Zoom call? We have a conversation with them and we can understand why they're doing it, what their experiences are, how they're going to do it. So I do think that you need to really attentively study these things before you do them. And in any investment, right, if it looks too good to be true, it probably is.
No, I mean, due diligence in every investment, I think, is that, you know, it's key. And in any of our worlds, it's, you know, what I am fascinated by the potential for. I love the idea of regulation onto some of these smaller markets. You know, where if you want to raise like $100,000 or something for that, you could rather than if you want to float on an exchange, it's $1 million to get a float to raise money. That's just, it's prohibitively expensive, and it's stopping innovation in a myriad of industries. You know, not just finance, but across the globe, whether it be cannabis or anything. So, and I think it would be really great if the world could come to an idea that, you know, let's get some basic regulation over this and some general rules. And then, you know, people can start going off and they'll have a lot more confidence that it isn't a fly-by-night or just a pyramid scheme to get, you know, and everything's going to collapse and the founders are going to walk away happy.
Yeah, and I love the idea. Like Tom mentioned ICOs earlier, you know, that was craziness. That was, you know, there was so much real stupidity. Like, these guys have a great idea. Let's give them $50 million, right? You know, usually it's like, you guys have a great idea. Here's $50,000. Come back when you have a business plan. And then say, okay, we'll give you $500,000. Come back when you have an MVP. But, you know, this idea. But I do think that the main idea, the impetus, the idea that we can push funding out to entrepreneurs who can't get to New York or Silicon Valley or London or Tel Aviv or Shanghai is a super powerful idea. And I'm certain it will happen. And I, you know, am waiting for it to happen because I think that is, you know, something that will make the world a much better and more positive place. And I do believe that we're going to get there faster than we think because of the ability to create blockchains that allow us to interact with people that we don't know and that we don't have to trust because the system itself creates the parameters for interaction.
I'm going to take two more questions that I've seen from the audience, and we'll ask you to give brief answers if I may. So it's a big topic, ESG. Simon mentioned it, And so we have a skeptic here who said that ESG feels like it's a bit of a bubble, and puts the example of, especially when you have someone like Gazprom that's considered to be ESG compliant. It sort of feels like it might be a bit of a due diligence virtue check, if I quote. So question to you, I'll put it to both of you, Dan and Simon, is there a risk that this is becoming a bit of a diligence virtue check, or should we be thinking about this in a different way?
Well, you know, I, as you mentioned, I sit on two boards of two natural resource intensive companies. And so I understand the skepticism about ESG, which is just another name for what we used to call CSR, corporate social responsibility. And there is an increasing requirement, because so many funds now at least screen for ESG, and some actually filter against ESG to look at this as sort of like, you know, a check the box exercise. But for me, for me, it's a very powerful thing, because it really allows us to do what we should be doing. You know, I'm an independent board member on both of them. And that is to really be pushing back. Are we really taking care of our workers? Are we really taking care of the people in the communities where we're doing intensive mining or cutting of forests? And I also think it's a really amazing idea that, given the current state of our planet, that we really need to be much more aware of what is the full impact of our investments. And unfortunately, if I were to criticize ESG, and sorry, I see Simon Letchkin, you know, I would say that there's too much E and not enough SG. Right? Because I do think that the governance part, you know, making sure that people are really investing in companies that are transparent, that the independent directors actually have an impact on the governance of the company, is something that we should pay more attention to. And I believe that ESG will do that.
Obviously a big topic and one we could spend a lot of time on, but Simon, a quick reaction.
I'm just going to say very quickly, it's a bubble. Literally, only 6% of companies have complete visibility into their supply chain. It's a tick box at the moment. That's not to say it shouldn't be more than a tick box, but at the moment, the people that go on about it are nodding dogs.
Well, I mean, you can say that, but like I can tell you, like I can just see in both of our companies, you know, that we're focused on how much greenhouse gases are we burning in our production, you know, on a per unit basis. I can't understand why that would be bad. Even if it just provokes the conversation, it's a positive thing.
It's not bad, but what are you doing about it? It's like you can talk about it, but it's the consequence of it. Not people are doing a lot of talking and not a lot of acting at the moment. That's the problem. Yeah. I'm not disagreeing with you. I'm saying I want more action.
Yeah, I think it's probably fair to say.
I agree.
Some companies have maybe embraced it in a more sincere way than others. I think that's probably a fair.
For sure.
Yeah, that is true.
As I had a last question, actually, that's come from Michael Choinaki, who himself is the founder of an interesting digital platform that's kind of changed the way companies talk to the financial markets. And it picks up on retail investors again, which we touched on at the beginning, and I think it's a good way to actually round this out. Saying, you know, with this sort of the rise of new information platforms and new technologies that basically make investment more accessible to a bigger pool, how do you see that shaping asset prices going forward, say in the next 5 to 10 years? Tough question, but you're both up to it. Simon, do you want to go first?
That's a great question. I love more participants, more participants, more demand, better prices. I think is the short answer to that. Also better liquidity. I mean, one of the things is you can't have high prices if we don't have liquidity. And so, you know, market participants provide liquidity. It doesn't matter what market you're in, whether you're in crypto, whether you're in, you know, large cap US. Liquidity is king if you want to get things, and also for an active market as well. So it's very beneficial.
Dan, where do you stand?
You know, I think it's a positive thing. I think, you know, I would go back to what I said earlier, which is, you know, I think we should expect, as the universe of investors gets bigger and gets to have more retail investors, we should expect the fundamentals to change. One of the things I think that's going to happen on markets is I think all investors will increasingly use algorithms to actually make investment decisions. And I think as more retail investors come in and use algorithms, we'll see, more algorithmically driven markets, which will be pluses and minuses. But I also think we'll see algorithms that start to measure sentiment. I think we'll see people making investment decisions because they'll be reading that Reddit chat and say, well, if all those people are going to buy GameStop, I'm going to buy it. It reminds me when I was running the trading desk at Troika in the 90s, and there was this huge pyramid scheme, MMM here, and all the traders had this crap, and I was like, guys, this is a pyramid. That like you're going to be left holding the bag. And you're like, I know it's a pyramid, and I understand everyone's going to be hurt, but I'm going to know, Dan. And I can tell you, when MMM got wiped out, there were a lot of sad faces on that trading desk. So, I think one of the things that's going to happen as this happens is there will be, a lot of pain out there, but maybe that will motivate people to become more educated about financial markets and fundamentals. And then, that will only be a good thing. And if there's more people with investable assets, that's obviously a hugely powerful impetus for their financial well-being and for the society at large.
We're at time, but I did promise I was going to force you to make some forecasts. And so, gentlemen, please take out your crystal ball and think about the next 12 months. What is the most surprising thing that might happen in the next 12 months in the financial markets? Simon, first to you.
Well, after 2020, are we really supposed to have, is there any less surprises left? 2021 actually will be full of fewer surprises. It's a good year.
I'll drink to that. Dan?
I think we will see, the most surprising thing is I think we will see the emergence of a fully accessible central bank digital currency. I think we'll see a meaningful country, probably in Asia, issue a fully blockchain central bank digital currency. And the reason I think that's important is because I think as soon as the citizens of that country or the residents have a wallet that has that currency in it, for them to have a Bitcoin or any other token becomes super easy. And so I think that's going to be the surprising emergence.
Dan and Simon, on your behalf, I will thank our great audience, actually, who sent through a lot of great questions, not all of which we had time to get to, but they're in the chats. And so perhaps you'll be able to follow up in due course with those we didn't get to live. And for me, to both of you, thank you very much. To Simon in Abu Dhabi, to Dan in Moscow, great to see you both. And let's do this again. Thank you, everyone.
And Tom, thank you so much for your very able moderation. Really appreciate it.
Yeah, big round of applause.
Thanks, everyone.